Welcome to Rich Mentality. Today we're going to go over the 2022 recession. If it's actually official, if it's a real thing, if we're scared or not, Welcome to
and
Rich
just
Mentality.
general
Today we're
shower
going to go
thoughts of a
over the
rich mentality.
2022 recession. If it's actually sorry, I had it up on another screen and I started hearing myself. Okay, so the first thing is it official? Well, by definition, it is 100% official that we are in a recession. So, just by straight definition, a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in two successive quarters. So, um, go nowhere but the Bureau of Economic Analysis, and quarter one of 2022, we were at a negative 1.6% quarter one, and then quarter two of 2022, we were at a negative 0.6%. So that's two negative GDPs. Therefore, we are officially in a recession. And that is the official and real question being answered. Now, whether or not we should be scared, um, I think as long as you stay true to whatever your personal and unique investment plan is, then there's nothing to be scared of at all. Every single person's goals are different, so your investment strategies and techniques are going to be different and probably ever changing as your priorities and goals shift as well. So I don't think anyone should be scared. And obviously, this is all for entertainment purposes. I'm not, a financial advisor in any way. So, um, just my personal thoughts on it is I think we'll see an overall percentage decline similar to what we saw in the '08 crash, but I think it won't be as acute and it'll be a little bit more chronic and spread out over the rest of this year, all of next year, and maybe potentially even into 2024. um, so I mean, there's a good chance that an overall broad index and S&P 500 will be kind of slowly declining for some time and then trading sideways for, you know, 3 to 5 times longer than that decline period, if that made sense. And that's it. Hopefully, no one's scared anymore. And we're going to go over the script of the inspiration of this live stream. It's recession times prep and what to do to keep your millionaire mindset. That's probably not going to be the name of the the YouTube video once I post it. But let's just kind of go over the script. I'm going to bring it over here. Okay, that looks good. Okay. The thought of a recession might spark fear in you, especially when considering we are by definition officially in a recession as of this quarter. Um, Interesting. Is it as of this quarter or is it as of last quarter? uh, we'll keep it. The fact that your investments can potentially lose a large percentage of their value in economic cycles is actually nothing new. It's actually, on average, what I think it's every 8 years there's a recession. Um, so technically we're long overdue, actually. Um, a lot of people don't know this either, but we actually were in a recession in 2020. But it was nobody knows about it or talks about it really, but the definition of a recession, we were actually in one in 2020, but we didn't. No one really talked about it or felt the repercussions of it because of all that stimulus. In this video, let's talk about being prepared for them. So you will. Oh, nope, I skipped. Sorry. No, I didn't. I'm just gonna skip that because I already butchered it. As much as we would like to think that the market is going to be stable and grow at a constant, steady pace forever, that's never been the case, so it's unlikely that it's going to happen in the future. Uh, yeah, 100%. We're we're in one now, and this is a good setup to let you understand that once it's over and the markets are roaring again and it's nothing but bull, 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 it will eventually happen again. The markets are going to have their rough spots and their streaks of excellent returns. Considering what actions to take before down cycles hit, ugh. Considering what actions to take before down cycles hit and during will save you money and dread in the long run. In fact, savvy investors are those with the rich mentality. See, you guys have to understand how long it actually takes me to make these videos. I mean, uh, 3 times as long to actually record it than it would take to say it once, and then probably 5 times as long in editing it all down to one coherent audio file. Rough. In fact, savvy investors or those with the rich mentality have the potential to make far more money than those who do nothing during poor market conditions, like we're seeing today and possible for the foreseeable future, which was my little ramble about. I see us going sideways, you know, 3 to 5 times longer than it's going to take, the average time of how badly we're going to crash. Um, I'm not saying it's going to be a bad crash, but you know, we're in the decline now. The first thing you want to do when getting ready for a potential recession is revisit your investments. Inevitable changes in the economic situation of the country can be unsettling for everyone, like now, which is literally why I had to put scared in the title. All-time highs of the stock market and rapid rises in real estate values are good things, but it's those with a rich mentality who takes note of these cycles. So be aware of them, acknowledge them, get educated on them, but don't be scared of them. We are in a slowdown now, and we prepare for it outside of these normal swings and key economic indicators affect us in the long run. Long term, stick with run. It's always important to make sure your investments are in line with your goals. Kind of spoke about this earlier, where everyone's unique. It just depends on, what specific goals you have and what are, the parameters that are in place that influence your goals. Like, do you want to retire early? Are you nearing retirement because of age, et cetera, et cetera? But it might help to be, oh, I'm just going to restart. It's always important to make sure your investments are in line with your goals, but it might help to more carefully evaluate your plans as the markets hover around all-time highs. With stocks 10 years or more into a bull market, we can reasonably expect fluctuations and adjustments in the near future. Like I said, I think the average, over the century or more data that we have on markets, I think it's every 8 years on average for a recession. If your investments do align with their goals, there's no need to make any changes at all at this time. Like, um, I think, the the majority, kind of like across the board, is just simply, you know, you know, hold for the long term. Buy and hold, hodl. That's all there is to it. But again, everyone's unique, everyone's different. Experts will tell you that while a market drop might seem like an immediate loss to your retirement accounts, investors should see this as a chance to buy lower priced stocks at discounted prices. Rather than seeing an economic downturn as a time to sell, think of it as a possible opportunity to buy stocks, real estate, and other assets at a discount. Absolutely. Everything's in the red, that means it's on sale. It's been said that the rich only get richer during recessions. I mean, it's like this next paragraph we're about to get into is like real estate. If rich people have a lot of money, so if you got the cash sitting around and prices plummet, then you're now only about to get richer because you can go buy up a bunch of discounted property. If you own rental property, consider your plans if the real estate market were to crash. Maybe you're tired of being a landlord, your retirement plans of living abroad. Within the within coming years, oh, your retirement plans of living abroad within the coming years wouldn't be landlord friendly unless you get a lot of property managers. And then it's like you're not doing anything anyways. You might have to answer an email from the property management every now and again. If that's the case, you might be If that's the case, it might be time to call your real estate agent and get the property listed in case something drastic happens. If the housing market crashes, banks are foreclosing on homes left and right, and the home value drops by 50%. I don't think that's ever happened. 50%. Um, I think I was trying to fearmonger here. Value drops, like worst case scenario, up to 50%. Waiting could be a poor strategy for someone who would rather be out of the game entirely. If you're happy holding the property over the long term and enduring any market downturns, man, live streams are rough. If you're happy holding the property over the long term and enduring any market downturns and fluctuations, there's probably no need to change anything. Consider also when the housing market is in turmoil, rents tend to hold steady or even increase. Oops. People can lose homes to foreclosure, therefore fewer home buyers, and people can't afford to purchase. Adding credibility to this statement, it's important to identify your short-term goals in order to properly assess what should be done. The next main thing to consider when evaluating your investments in turbulent markets is how soon you'll be needing the money. Are you getting ready to retire within a couple years, or are you young enough that a market downturn won't have any effect on your day-to-day life? When most investors buy individual stocks and funds, they should be prepared to hold the assets over the long term, usually 10 or more years. 20-year rolling averages throughout history have always been guaranteed a return. I think this is actually very important because I was looking over um, the graphs, and I mean that went back over a century. Um, and there are periods of time that you can pull out throughout history where a 10-year span did not yield a return. Now, on average, over 10 years, the stock market is around a 10% return on your money. But in the absolute worst case scenario, which there weren't many at all, there have been 10-year rolling periods that were not net positive. But at no point in time in the history of forever in the markets has there not been a 20-year period that hasn't, been net positive for a return. So I think it's important to also, just take note of the 20-year. It kind of helps you get in the mindset of, long-term hodling. If you have money invested that you're going to if you have money invested that you're going to need to fund your children's college tuition or a down payment on a house, it's probably time to sell and set cash aside. If you're not prepared to see your investments go down in value, then wait for them to recover. You probably shouldn't hold them either. For investments with the yield of 5 years or less, consider buying fixed income investments like bonds and consider adding more to a high yield savings account. Now, I'm not sure how much I agree with the high yield savings account. There's so many better things that you can do than the measly 2% you're probably going to get from a savings account. Um, Obviously, the bonds is already going to be a better yield. But let's brainstorm real quick. What would be better than just letting your money sit in a savings account, especially in times like now where inflation is higher than ever? So if you got a 2% return on your savings account, but inflation's at 9, you're still losing 7% of your cash sitting in that savings account. So brainstorm. Uh, well, I mean, just in the simple philosophy of opportunity loss, uh, things are already red, and it may decline more, sure, and may even possibly be years of sideways trading. But the opportunity loss of not buying into a market that's on discount, I would say is the problem. So I'm going to leave this in here, especially just because on the safe side, it's better to not risk your capital because it's FDIC insured if you put it in a bank account. You're never going to lose that capital. But if you put it in stocks, you could lose the capital. But just as a different perspective here, I would say continue to throw it into the market rather than a savings account. Just my entertaining opinion. Also, 3 to 6 months of expenses as standard practice for a cash emergency fund. This is kind of like the golden rule. You should kind of always just have that in cash. But in my most recent video is the bank churning video. Instead of just letting your cash just always sit idle and doing nothing, even in a 2% high yield savings account, should be doing something with it. Credit card churning, bank account churning, um, put it in CDs. Assuming you've executed a financial plan, it's best not to make impulsive decisions based on predictions of a poor economy or sudden downturns. Sticking with your plan, whatever your plan is, will leave you with the most money down the road. If the market plummets, it's not necessarily a good idea to sell off your stocks and other investments and then park your cash in a savings account, which is literally what I was just rambling about. Instead, hold on to your investments and wait for them to recover, assuming you have the time to wait. and aren't planning on using that money in the near future. Investors who stay invested long enough for a recession to recover usually enjoy healthy returns for years after. The stock market has always recovered its losses over the years and risen to new highs. Every time throughout history. There's, like I said earlier, there's never a 20-year period that you can pick out um, and have not made, at, I think it's at the very least a 10% return. Um, the bare minimum, it's 8% over a 20-year. As the saying goes, history tends to repeat itself. The people who sold at the bottom of the Great Recession, which is '08, were only left with about half the money than what they had just before the downturn. These are the same emotional investors who take years to build up the courage to begin investing again, at a time when values are high, which usually means the market is probably late in the cycle once again. So, basically, don't let your emotions get you. Just dollar cost average in nonstop at all times forever. On the other hand, the people who are able to continue buying investments before the market crashes and during the market crash have the chance to buy assets for a deep discount, having faith that the market would recover its losses, and then some as it's done every time in history. It's best not to panic. Smart investors aren't selling at a low. In fact, most are buying as they see a plethora of opportunities. If you're in a stable financial position, this can be an excellent opportunity to add to your investment or retirement portfolio. You could compare a stock market drop to a sale in your favorite video game or clothing item. If your favorite game or shoes go on sale, you might see this as an opportunity to purchase more, to purchase them. You would be gaining the opportunity to buy the same item for less money. This is how successful investors view bad times. And the markets, how they view bad times within the markets. In fact, many investors have made the majority of their money by taking advantage of severely low priced stocks and other assets. When the market finally recovers, it's common for investors to profit very handsomely. Handsomely. Smart investors don't use their emotions to sell or buy stock. They look for bargains during lows and sell during highs, giving careful evaluation of their trades. Timing the markets can be very difficult because it's impossible to know when the economy will hit rock bottom and how long the recovery is going to take. Like when I gave you my BS prediction, that's all it is. It's BS. Nobody knows. There's not a single soul that knows. Nobody knows, um, how bad the crash will be, what type of crash it'll be, how long it takes to recover, how long you trade sideways afterwards, all that good stuff. Nobody knows. That's why dollar cost averaging is really good. Also, whoops. Also, market downturns happen very quickly and unpredictably. However, poor markets can be a great time to seek out to seek out opportunities if you see stocks with proper fundamentals. Trading at a steep discount increases the chance of it being a solid investment. Also consider when your index funds and ETFs are trading at a fraction of the price they were in the past, it's likely that the price is considered a discount. I don't know about funds and ETFs being a fraction of the price that they were. I mean, the world probably has already ended. A fraction of a fund? Keep this perspective even if other retirement planners are having a nervous breakdown and selling off all their investments thinking that the sky is falling and that the world is ending. I believe this is called the Chicken Little syndrome. They might even ask if you're crazy for considering further investments during a market in turmoil. But the fact is, the investors who buy assets on sale are the ones who make the most money. The rich get richer. Contributing a higher amount, hold on, let me remove any negative connotation to the phrase that I just said. The rich get richer. Sure, but those with a rich mentality get richer too, and it doesn't matter how much money you have, anyone can have the rich mentality. Contributing a higher amount to your investments during a poor economy can often work out very well. If you're in the position to purchase investments during a poor economy, buying property on sale is a great way to invest in real estate. Rents often stay strong during poor economic cycles due to home sales remaining steady or falling. Most people just don't have as much money to make purchases or they don't feel confident about the future economy. In some cases, when the stock market falls, interest rates often are cut by the Federal Reserve, resulting in lower mortgage rates. This is often this is often done to entice people to buy, but many people still choose not to due to looming fears. Now, obviously, 2022 is drastically different, but I think that's why we're going to trade sideways for so long too, because once once the Federal Reserve stops raising the rates to combat the inflation, they're going to have to immediately start lowering them again to get the economy going again. So uh, I'm going to leave this paragraph structured the way it is because 2022 really is a unique situation coming off the pandemic. Combine that with a selection of lower priced properties and cash flowing deals will be much more plentiful. This creates more opportunity to purchase a property that cash flows covering the monthly financial commitments and leaving the owner with more money left over. With money left over. Once the property regains its value, it can then be sold for a healthy return or held onto for many more years. You guys like how I just add stuff in. I don't know where it comes from. I add stutters and slurs. Have you ever heard a story of a friend or acquaintance that had bought up property during a poor market and then rented it out for a few years? It usually increases in value, sometimes by an amazing amount, and is worth much more than what was originally paid. Everyone's got that somebody that they know where, um, if you're still struggling with the poor mentality rather than the abundance mentality or rich mentality, and poor mentality can be traded out with scarcity mentality, you probably feel some type of way about the person that you would describe as bragging, but instead just look at as an opportunity that they took during that time that if you knew them, then they're probably around the same economic situation that you were in at the time. And then if the situation ever rises in the future, you can now take that learning opportunity and turn it into an action. Because, if that happened in '08 for somebody that well, we're about to go in through one now. So be prepared with the rich mentality. Not uncommon for houses, apartments, and condos to sell for less than the replacement costs or the money that would require to rebuild the property altogether. Vacation homes are often the first to be sold off. This can create a buying opportunity for savvy investors with enough foresight and access to funds. The vacation home in the mountains or on the coast, the beach, I think I want to stick with the beach. Who says the coast? Why did I say the coast? Is usually purchased when the economy is roaring along. Then it's often sold when the market deflates, creating bargains for the investors. Investors who prepare for these downturns by keeping sufficient access to capital on hand to scoop up real estate bargains are able to then sell the properties for a large profit when the market fully recovers. They might also have the option of renting them out for years and enjoying increasing rents and cash flow. While not everyone will be in the position to do so, or they might not have the confidence to do such a thing, scarcity or poor mindset, those with an abundant or rich mentality now have excellent potential. If you're nearing retirement in the if you're nearing retirement in the fear of a recession, it will be bothersome. I think that's definitely bothersome. It's a way worse feeling than bothersome. Uh, I'm gonna leave it. This would be a great time to have an audience and ask what would be a better word. However, consider that proper retirement planning was already taken into account. People who have a fully funded retirement portfolio that's properly allocated to the right investments should be able to absorb the impact of a market crash, assuming it will recover over time, because it's not a matter of if a recession will come, but a matter of when. If you're going If you're getting ready to retire and a sudden market downturn would mean you're living on the streets or moving in with your children and grandchildren, you're probably better off staying on the job for a few more years and increasing your nest egg. Passive income streams. Oh, that was all one sentence. I'm not going to say it again though. If possible, also take into account the allocation of your portfolio in order to achieve your goals. If possible, in order to achieve your goals, everyone's situation is different, but as you near retirement, more fixed income assets are generally recommended. So basically, um, get away from capital gains and move more towards cash flow. So this is dividend stocks, rental properties, um, and basically, it's just simply put, um, the bothersome word, uh, cash flow assets and investments aren't as volatile, so you can continue through into your retirement, regardless of what the market cycles are doing, which is generally why, fixed income assets are generally recommended. Investing for the future is a long-term game. If the markets start to get rough, there's usually no need to panic and sell off your investments in order to limit potential losses. That rarely ever worked out in the long run for anyone or for the market as a whole. If the money you have invested won't be used for any expenses in the near future, the best thing is to keep investing and enjoy the fact that you can buy assets for a fraction of the cost. That's the discount sales, everything's in the red. Consider market downturns as a way for you to buy stocks and real estate for a steep discount, and be confident that the markets will recover as they have always done. They always do. And if they don't, it's probably the end of the world and it doesn't matter anyways. So whether you held on to your money or you threw it all into investments or you lost it all, if it actually is the end of the world, then none of that money matters anyways. So you might as well dollar cost average in and look for the future. Be hopeful, but not like not being hopeful is good, but you still need to make sure you have, a sound strategy to investing and building your wealth that, is aligned with your goals specifically, whatever those might be. We are all utterly unique creatures. If your time frame for investing is short, then consider selling volatile investments and keeping your money and more stable assets that you'll be happy holding for years to come. And remember, with each video you watch here on this channel, the rich mentality will become your new comfort zone. Is that what I said? Yeah, it was close enough. So stick around. That was um I started at 5:30, so 36 minutes. Is that good enough? I mean, if I had an audience, um, we would be engaging right now. Like, cause like more than anything, what I want eventually is, I'm not 100% sure if this is what Dave Ramsey does, cause I've actually never watched his stuff, but um, some sort of talk show where, um, anybody can come on and ask me, questions about, credit card scores and what they would do for bank account churning and because I see myself as like the poor man's like meet Kevin, like people like him and maybe even Dave Ramsey's they could probably go into like options trading and teaching you about like the fundamental analysis of a good stock purchase and things like that. I'm more of like the poor man's of those where we're still just on the initial stages of just like understanding it all, getting out of debt or just the bare minimum of budgeting to not go into debt, and then smaller things like bank account churning. I know I'm beating a dead horse with that one, but it's just the best. I mean, you literally can go online to chase.com right now and make $300 for free right now. Go type it in www. Well, I don't do www. Just do chase.com. And on right on their homepage, if you set up an account and then put your direct deposit to it, you need zero money. You'll make $300. It takes less than an hour to do that, but let's just say it takes you one full hour. You just made $300 an hour. Bank churning. Anyone can do it. Anyone. And then I guess I would just kind of roll right into some Gary V motivation. You can now take that $300 and go do trash talk. If you don't know what trash talk is, you just go around to um, thrift stores or garage sales, um, buy stuff for pennies, dollars, and then turn around and put it on eBay and I don't know. He gets yields of upwards of 100x, if not higher, on some of the stuff he gets from garage sales. I mean, he's a multi millionaire at this point, and he's still doing this stuff to this day. He will go to a garage sale as a multi-millionaire, spend $12 on some magazines, and then turn around and sell the magazines for thousands. It's ridiculous. Um, that that's somebody you should definitely follow if you don't already know who Gary Vee is. Yeah, I guess I'm dragging this on long enough. You know, thanks for watching. Um, and I'm gonna keep doing these no matter whether people are watching or not, because I do eventually think, you know, some one-offs will eventually see this content and maybe I could help them in some way with their mindset or financial future, and that almost brings a tear to my eye. I would love to be able to be that person for someone at some point in time. So yeah, thanks for watching, and until next time.